Thank you very much, Lauren. Good afternoon, everyone, and once again, welcome to Acwa Power's financial results conference call with the investors. As Lauren has mentioned, in this session, we will be covering the 6-month 2022 period, which ended 30 June 2022 for our financial results. Together with me, I have Mr. Paddy Padmanabhan, who is sitting in Riyadh, and he's the Vice Chairman and CEO of Acwa Power. Next to him is sitting Mr. Abdul Hamid Al Muhaidib, and he is the Deputy CFO of Acwa Power. And the three of us are going to host this call this afternoon. If I look at the agenda, we are going to be starting with the highlights, and Paddy is going to take us through the highlights of the quarter as well as the 6 months of the year. After that, we're going to go over the financial review. Abdul Hamid is going to take us through that, and we will have the closing remarks by Paddy. All of this is going to be followed, obviously, with the questions and answers session as usual. So without further ado, let me just give the word to Paddy. Paddy, it's all over to you, please.
Thank you. Thank you very much. Good day to all of you. Thank you for sparing time and joining us. And good day to my colleagues too. Again, my pleasure and privilege to be sharing the salient features on our performance of the last quarter. Good news in that we've had a very solid quarter in terms of project development, a very strong performance. We signed power purchase agreements for very large projects like the Egypt 1,100 megawatt wind farm, a 91 megawatt IPP photovoltaic plant in the kingdom, and also, for me, quite excitingly, a water purchase agreement at Shuaibah. It's called the Shuaibah. Technically, it's called the Shuaibah 3 IWPP, which is actually taking our first investment in the kingdom when we were founded. Shuaibah independent water and power plant that is oil-fired. It's to take that site, decommission that plant, and convert it, effectively put in a 600,000 cubic meter a day desal plant. So what is significant about this, quite apart from all of that, is the fact that we will be decarbonizing, continuing our quest to decarbonize our portfolio, and we'll be taking out 9.5 million tons per year of carbon dioxide from 2030. So that's those are the kind of exciting projects that we're involved with. We became preferred bidder on 2 floating solar photovoltaic plants in Indonesia. We went to Indonesia a few years ago, and these are the first lot of bids that we submitted, and we're very pleased to see 2 very interesting projects. We've become preferred bidder. We'll be working to close that project and take it into construction. And then we have gone on we've got a very solid sort of bid pipeline, as you're aware. So we've gone on to now prepare submissions for some of the interesting projects. A 500 megawatt photovoltaic independent power plant in Uzbekistan, a 600,000 cubic meter a day independent water and power projects in the Kingdom of Saudi Arabia, and at Amala, which is a site between Neom and the Red Sea in the kingdom, along the Red Sea coast, the second mega tourism project in Saudi Arabia. So as you're aware, we are already the utility service provider for the first one, the very iconic Red Sea project, regenerative tourism project. We're now bidding for the second one. And also we have, as you're aware, we have a framework contract. We call it the PIF Strategic Framework Agreement, within which we are developing and will be developing several projects over the next 8 years. And we've already gone into construction on the first one. We have now submitted the proposals for the next. And during this period also, we've made lots of progress on the Neom green hydrogen project on the financing, and we now are confidently expecting to achieve financial close on green hydrogen, on the Neom green hydrogen project, the first project of this scale that has gone into construction in the world. And it will be the full notice to proceed will be released to the EPC contractor, and the project will proceed on track. And finally, in terms of technically, in terms of project development, if you like, Jazan, at Jazan, the Group 2 set of assets should start being transferred to us in October 2022. And then we've got also on the operating side, which is very important for immediate sort of revenue generation, 3 projects have either started to come online or has completed coming online. So Tawila, the largest reverse osmosis plant that is being developed in the world. The first phase of it, 50% of the capacity came online in this quarter. And at Al Dur in Bahrain, we brought online the second and the final phase of this very large IWPP. And at Dubai, where we are building this, we're building a very large CSP plant, and we're also in construction on a big photovoltaic plant. Additional capacity of another 100 megawatts came online. And these projects are now obviously contributing to revenues. In fact, in terms of numbers, 249 million Saudi riyal is contributing into the revenue and the operating income line before impairment and sort of losses. And that includes the O&M component of it during the first 6 months of this year. I think you will see a lot more detail on some of these sort of fairly large iconic projects, including values in terms of project costs. I'm not going to necessarily go through that in detail. I think you're much more interested in the actual financial numbers. Okay, so that's all. Lots of improvement, lots of growth, on track, exciting stuff. But I absolutely need to also be very frank and share with you that there are some really, really significant sort of challenges that we're also having to work through. The first one is that I need to, I'm very disappointed, sad to share with you that we had 2 fatalities in the 6 months on our sites. Look, safety is very, very much our first core value, and we are redoubling our efforts to live that core value and convert it to practice as well. Losses are not, people tragedies are not something that any of us want to report on, but they have happened, and I need to share that information with you. And the second one is that we continue to be, unplanned outages are expected because we are operating these kind of assets, and we don't plan for them, but we recognize a certain level of them and we budget for them. But disappointingly, we are seeing more outages than we would like, and even more concerningly, more of these outages are due to failure of equipment supplied by world-renowned, world-class OEMs, original equipment manufacturers. But okay, this is the challenges that we have to deal with on a day-to-day basis. Overall, the numbers are not terrible. They are not as good as they were if I were to compare them from the last year, the same period, if you like. But at the same time, they're reasonable. Power is still running at 86% as opposed to 88% in 2021. Water is running at 96%, which is a little bit better, I guess, than the 92% of the prior year. But we don't want these outages. We need to minimize them. We are redoubling our effort on understanding failures, single point, root causes, and we're putting a lot of effort into increasing reliability of supply. And we're also putting a lot of effort into digitization and predictive performance monitoring in order to reduce these kind of failures. And then, of course, the third challenge that we are having to manage, which we have to deal with it, even though it's an external matter, the war impact on the ongoing war in Europe, and the ongoing COVID sort of shutdowns in China, and coming out of COVID, the supply chain challenges and the stresses that we have had. The bottom line is that we're in a period of global high costs, rapidly rising inflation levels, and fairly tight component supply, equipment supply. And of course, this is affecting our projects that are in construction, as well as we're being very careful with projects that are in advanced development. Look, the good news is that we are able to work with our partners, our construction partners, our OEMs, as well as our project counterparts, off-takers in negotiating relaxation in project deadlines, and working with also even governments, invoking government relationships to help ease supply chain. Overall, we're not seeing, in terms of financial process on new projects, on the projects that we're working on, we're not expecting any delays to financial process during the remainder of the year. We for sure will expect to see some additional costs in projects that are in construction as a result of these challenges. But there are contingencies. That's what contingencies are for. And we expect to work hard at managing these cost differences through such facilities we have. I think with that, let me pass you on to Abdul Hamid to go through the kind of critical detailed bulk of financial review for the quarter.
Thank you, Buddy. Assalamu alaikum. Good afternoon, everyone. Allow me to give you a quick, maybe before we start on the financial side, we can give you a quick reminder and refresher on the key financial metrics, which is the foundation for the upcoming few slides. So if you are joining us for the first time, this is a key slide to understand. So we have 5 metrics when it comes to financial reporting. The first one is related to the operating income before impairment losses and other expenses. And this is in line with what we are reporting in the audited financials. So it will show you the exact operating income before impairments. And then on the second one is the adjusted profit attributed to the equity holders. And on this line specifically, it will be the profit adjusted to any non-routine or non-operational items. And every quarter we will show you both the profit, the net profit, and the adjusted net profits for you to be understanding the full picture. So these 2 metrics, we are reporting them in a quarterly basis. On the semi-annual basis, we are also including 3 key financial metrics. The first one is the current operating cash flow. So this metrics has 3 main components. The first one is the distribution from the project company and NOMAD. And the second one is all the fees related to the management fees, services, development revenue. And the third and most important one also is the optimization part. It's come to the sell down or disposal of assets. All these elements contribute to the parent operating cash flow. The fourth one is related to the parent net leverage. So here we are showing all the recourse borrowing to the parent, and also including any off-balance sheet recourse facilities. You know, sometimes we do have equity bridge loans, equity standby LCs that are off-balance sheet, but have recourse to Acwa. So based on that, we are also including them here, and we are netting all of that from the cash, based on which we are getting the parent net leverage. Finally, we have a ratio which is the parent net leverage divided by the parent company cash flow. So these are reported in a semi-annual basis. So what we're going to present now is a summary of the financials, and please feel free to access our website or to our website. You will get much more details when it comes to the MD&A, the presentation, and also a detailed investor report. Moving to the second slide. So here, also another important slide when it comes to what has changed, right? If you want to compare quarter 2 to quarter 2, or also the full year, half year of this year compared to the half year of last year. So we are showing you here, let's say, the new changes that is important for you to make the right comparison. So during 2022, also referred to by Paddy in his opening speech, we have 3 units or 3 projects that came into operation. So these units have been contributed positively to 2022 compared to 2021, which they were under construction. This one was Al-Dur, both the power and water side, Tawila IWP in Abu Dhabi, 50% capacity, and 100% additional capacity in Diwa phase 5. Also, if you are comparing the first 6 months of this year compared to the first 6 months last year, you have to add into account the project that came off the last, let's say, 2 quarters of last year. So there has been several projects, 9 projects that has been coming online during this period. So we needed to add to this comparison. So this is an important slide to show you what has been added. So moving to the actual operating income before impairment. So here we are comparing both 6 months of last year to this 6 months of this year, and you can see that what was mentioned also in the opening speech by Paddy, 250 million riyal contribution coming from the operation of the assets, including the Nomax side. We have also another 80 million coming from other operating income. Big part of it, 66 million, is coming actually from a liquidated damages, which is an LD was collected in North 3 from the APC contractor. Another 50 million was added from other incomes, including a difference between the, let's say, LTIP that was calculated last year on 18 months basis, whereas in this year was only 12 months. So there was an upside here as well. On the other side, we have the 255 million lower contribution due because of the outages we had this year, unfortunately. So this is including North 3 outage for the motor salt and tan. This is still there, and we have reported that to be until October, November of this year. We have also other big outages that was reported earlier, which was North 2 in Morocco. Now it's back to operations since April, and also Hajr and Al Murjan in Saudi. So with that, there was also a reversal of impairment in Shaiba, which was mainly due to the conversion that Paddy was talking about, since we signed the MOU at that time. So this brings us to 1.1 billion riyal for the 6 months of 2022. Moving to the net profit. So here we are showing you both the net profit, the reported net profit, and the adjusted net profit. So when you look at the reported net profit, alhamdulillah, it was a 21% increase compared to last year. This has been mainly driven by higher operating income, and also there has been a part included for financial income increase, mainly due to some deposits that has been contributed positively when it comes to the financial return. Also, there has been other income coming from financial income coming from other related parties. And on the other side, there has been a negative income or a negative impact of 33 million coming mainly from the loss of sale of Shukek, and also some loss of Shukek revenue on the first quarter of 2022. There is also another 143 million coming mainly from the deferred tax in Morocco, and also it includes other zakat and tax expenses for the 6 months of this year. This brings us to 542 million net income when it comes to the 6 months of 2022. So if you take out, let's say, the deferred tax impact, this is almost an increase of 54% of the reported net income and around 25% of the adjusted net income. When we talk about the adjusted net income, this quarter or this year, we didn't have much of adjustments, so it has only 2 small adjustments or reversal. One is 12 million reversal due to raised party. This is mainly because of better performance in Kirikiri. They ended up also paying operational fee to Nomad, which ended up in a reversal on a previous provision. Also, there has been a reversal on a 14 million on Vietnam project, and this is mainly because also we were provisioning a bigger, let's say, cost as compared to the final settlement that we had after the transfer of the assets. Moving to the next slide. So here, we will not spend much time about the adjusted net profit as we just explained it. But one important element here we would like to emphasize on is that the operating model of Acwa Power includes 4 main components. We develop, we own, and we operate, and we optimize. And the beauty of this model is give you a very well diversified income. And as you can see here, almost equally, the 4 components of our operating income has been contributing almost equally for the 6 months of 2022. So both the development, the ownership of the assets, and the operation of the asset, and the optimizer has contributed to this adjusted net profits. Moving to the third reporting metrics, which is the parent operating cash flow. So in this one, we are breaking down also the. So we have also distributed. We have actually divided our parent operating cash into the different elements to allow you also to easily compare 2021 6 months with 2022. So the distribution, you have seen a better distribution for this year. We have also seen a big upside mainly on the capital recycling. This has included, which is 1.6 billion riyal. This is mainly 2 elements. One is RAWC, which we did a refinancing of the assets, and also the disposal of Shukaiq assets that has happened also during this 6 months. Also, if you look at the parent operating cash, there has been a big jump, almost from 260 million to 2.1 billion as of today. On top of that, actually, we have also a big cash position, mainly coming from the IPO proceeds. We continue to invest on the specific investment that we continue which we have been investing in the last period, including Hassian, where we continue to distribute our equity, contribute our equity there, and also financing our green hydrogen project in NEOM through the notice proceed, which was announced also during this last quarter. On the consolidated and parent net debt, this is also an important slide to understand how we arrived to the net debt of Acwa Power. So we are showing here that basically we have both recourse and non-recourse facilities at our balance sheet. So if you take out first what is non-recourse on a balance sheet, and this is mainly, it was consolidated because of our ownership in these projects, but in reality, they are all non-recourse. So if you exclude this 20.5 billion riyal, you will end up with the recourse facilities of 7.7 billion riyal. This is including, of course, the revolver facility that we have and the 2.7 billion riyal sukuk, and also other corporate facilities like the PIF and Silk Road Fund facilities to our balance sheet. Adding to that another 7.2 billion, which is mainly off balance sheet, but recourse facilities, which is mainly equity bridge loans, equity LCs, you will end up with a total parent leverage of around 15 billion. With this 15 billion, if you subtract the cash of 7 billion, you will end up with a total parent leverage of net leverage of 7.9 billion. All right. With this number, if you take the simple ratio between the parent net debt and the parent operating cash flow, you will end up with a very low number actually this year, 2.3 multiple, and this is actually below our expectation, and so let's say one-off, and the way that we would like to see it in the future, as we mentioned earlier, is between the 5 and 6 multiples. And for that, if you just exclude the capital recycling that we did, we'll end up actually with a parent net debt divided by a parent operating cash of 5.3. And 5.3 is more or less in the same range that we are expecting. It's much better than what we have reported back in December 21. With that, I will hand it over back to Fadi to give a closing remarks.
Thank you. Thank you very much, Abdul. Well, fairly straightforward closing remark, really. As you can see, very strong progress in project development, including now the PIF pipeline starting to kick in properly. And the projects becoming operational, which is part of our business model. We develop, we get things built, they come online, and they keep adding to our portfolio, creating additional stable and visible income and cash flow streams. Look, yeah, so the sad part, we don't like these plant outages, but they are happening. But we are taking very strong action in order to increase reliability of supply. And we're using all the tools that are available, including now increased use of digitalization. Robust 6 months of the first 6 months of 2022, and a healthy balance sheet. We've had a quiet year in terms of financial closes, just things sort of building up. All that means is we're going to have a very busy year, busy 6 months now, wrapping up. So we do expect several financial closes, which will inevitably then, well, good news, result in higher development and construction management fees. We are continuing to monitor this ongoing war situation and the rampant inflation and the tight supply chains, and doing our level best with the support of our construction partners, our suppliers, as well as our stakeholders, our counterparties, to continue to deliver solutions and minimize and manage those additional costs. And we are not expecting a major sort of an adverse impact on projects that we are working on. With that, I will hand it back to person managing the calls for questions.
Thank you. If you would like to ask a question and have joined via Zoom, please press the raised hands icon on your screen, or alternatively, you can type your question into the Q&A chat box. If you have joined us on the phone, please press star 1 on your telephone keypad. When preparing to ask your question, please ensure that your line is unmuted locally. We will pause for a moment to allow questions to be registered. Okay, our first question is a written question from Dilshan Panchihua, who asks, do you receive any insurance claims for the loss of revenue due to plant outages? If yes, what would be the percentage of the lost revenue or operating profits?
Quick answer, and then you can take any details you want. But yes, we do have insurances, and we obviously make sure that we maximize those claims, or we optimize. We claim whatever is due. They do have deductibles. In order to, you can just about insure anything, but they come at a cost. So we do sort of balance them out. So there are some deductibles that we need to be concerned about. Look, these are all bespoke, transaction by transaction. It's all different. The insurances are related to very specific events. What we can tell you is that we are definitely able to recover quite a bit from whatever is due from the insurances. But what I'm not going to be able to do, and I'll be amazed if anybody else can do it, is to give you percentages or numbers, because as I said, they are bespoke, transaction by transaction. Somewhere in our numbers, definitely you should be able to see the insurance proceeds, how much we have received in insurance claims. That is there. But then, I wouldn't suggest that anybody take those numbers and do any magic divisions and come up with as a sort of standard average for the future. No, it'll vary on a transaction by transaction basis.
Yeah, thank you, Paddy. Just to add one important point, that we only book, the insurance claim only once it is we actually only once it's approved by the insurance company. So once it's booked, we actually show it also on our financials. So there is a number of outstanding insurance claims that we are continuing discussing with our insurance agent, and whenever we close the case, it is being reported actually on our financials as a proceeds coming to the to Acwa Power. Yeah.
Thank you. We have another question from Dilshan, who asks, how does the war situation affect your projects apart from inflation and supply chain issues?
Look, I mean, the straight immediate sort of impact is we have projects, for example, in Uzbekistan. We are moving, as part of those construction, very large components, wind turbines, gas turbines, and the only way you can move stuff, looking at the geography, we're going to come through the Black Sea. Well, unless we start building roads and bridges on the right-hand side, which obviously is not our job. So, and right now, insurance cover is a big problem for trafficking through the Black Sea. And of course, in terms of passing through the Black Sea is very much in a hiatus, virtually on an hour by hour, day by day. So we are having to therefore delay. We're having to resource. We're going to have to. So there's a whole lot of strategies that being worked in order to manage this. But that's the immediate sort of issue. And the other issue of war, of course, is the energy crisis. And that also is impacting in terms of stuff that is in construction. We're adding to the inflationary pressures.
Thank you. As a reminder, if you would like to ask a question and have joined via Zoom, please press the raise hands icon on your screen, or alternatively, you can type your question into the Q&A chat box. If you've joined us on the phone, please press *1 on your telephone keypad. Our next question comes from the telephone line from Oliver Connor from Citi. Oliver, please go ahead.
Hi all. Thank you for the presentation. 2 questions. The first one, just a statement around bidding on the PIF frameworks within Saudi.
So sorry, we did not hear the question. Yeah, we're breaking up. Well, okay, PIF framework bidding. Go on.
Can you hear me now?
Okay, yes, I think maybe better. Go on, keep going.
Yes, so the question's on the PIF framework. So can you remind us what capacity is actually on offer here? Is this to do with the sort of round 4 and 5 renewable auctions that had been mentioned previously? And the second question is on your project in the 1.1 megawatt onshore project, obviously significant scale for that technology. Could you give us any indication of how you see the levelized costs of these projects coming in terms of they being signed? Obviously you've got a view on the overall capital cost, but a sense of load factors and where that would come as a competitive supply of onshore wind versus other markets around the world. Thank you.
Okay, I'll answer both of them as best as I can. First of all, on the case of bidding the PIF framework contract and the next project that we have submitted our offers to. Okay, so just to be very clear, you then started to talk about round 4 and round 5 and so on and so forth. Okay, so just to be clear, the Kingdom of Saudi Arabia is deploying a significant amount of, well, it's very public, a significant amount of renewable energy capacity. Stated objective is 70% of the 70%, sorry, no, 60 something gigawatts by 2030. Now, then that total number has been split into 70% and 30%. 30% has been given to the Ministry of Energy through the Renewable Energy Procurement Agency, REPDO, in order to tender it transaction by transaction in groups. So that's the sort of round 4, round 5 that you were. So that's a tender process, and we participate in those. So in fact, some of the projects that we are talking about, I think it's Laila, whatever, is one that we won on one of those rounds. So we continue to do that, and that's an ongoing process. Quite separately, the 70% is being entrusted to PIF as the developer, and a whole series of projects to be developed over the next 8 years. And Acwa Power is the partner with PIF in that program as the developer, investor, and then operator. The first project, Sudair, is already, I think we have reported on this, it has already gone into construction. It is in construction right now, 1,500 megawatt photovoltaic plant. Now we have got, okay, so that took quite a while. We agreed those framework contract, the overall framework contract some time ago, and then always the first one to structure that contract. Because these contracts are, by the way, we don't just invent the tariff, we have to demonstrate competitiveness by relating them to the competitively bid procured tariffs. So there, we had to establish all of that comparison methodologies and everything else. And now we have achieved all of that. First one has gone into construction. We are now starting to sort of roll forward on that program. And so we got a second one that has been submitted. Because it has been submitted, it's now to be then evaluated by PIF and then finalized with us. I'm not able to share much more details beyond that.
Yeah, we did mention only that it is actually more or less more than actually 2 gigawatts.
Yeah, so these projects will tend to be fairly large. Okay, that I can tell you. So when you're going to do 42 megawatts, you're not going to do it 100 megawatt at a time. So the first one was 1,500. That's in construction. This one is over 2,000 megawatts. So they will be fairly large projects. But beyond that, I'm sorry, I'm not going to be able to share details with you right now. In terms of the 1.1 megawatt wind farm that we signed PPA for in Egypt, we've signed that PPA. It's a tariff public yet. Yeah, I mean, all these contracts end up with too many layers of confidentiality agreements, so I'm not sure whether we are able to share tariff with you. If we are able to share tariff, we'll sort of send it through to you or put it on the website.
5.6 billion.
But in terms of total cost, it's that I can tell you, it's a 5.6 billion real total investment cost. The tariff is very competitive. Egypt has got good wind resources, so it should be a fairly competitive tariff. That's about all I can tell you on that one.
Thank you. As a reminder, please press the raised hand icon on Zoom or type your question into the chat box, or please press *1 if you've joined us on the telephone. We have another question from Dilshan Panchahua from Falcom, who asks, where do you see your company in 2030 in terms of power generation capacity and other segments?
This is an easy one because whatever I say is going to be wrong. No, that's not true. If you go to the 1,000 plus page of IPO documentation, you will see that we have given an enormous amount of detail on what we regard as a very visible pipeline opportunities ahead of us, both for power generation as capacities, as well as desalinated water. And now, as we have stepped into the hydrogen, which is an emerging opportunity, we are starting to put together numbers. The Kingdom has published its own vision for hydrogen. We are developing the first one. Many countries that we operate in have already published their visions as well for hydrogen, and we are starting to step in and look at projects. So that's something that we will develop and start to share more detail in due course. But certainly for power and water, you can see a lot of information on the pipeline in the IPO document, IPO prospectus. But at a kind of conceptual level, I think what we have said is that with the stuff that we have got in construction already and that we are busy in very advanced development, some of which have now actually happened since IPO, we expect to double our operating platform by 2025, and we expect to see treble by towards the end of the decade. Okay, so those are all sort of numbers and details that are there in the IPO documents.
Thank you. We currently have no further questions, so I'll now hand you back over to Oscar Sarind for closing remarks.
Oh. Wow.
Thank you very much, Lauren. Thank you very much, Paddy and Abdul Hamid, as well as other people who are and were in the call. But hang on, we just received, Lauren, I guess we received more question.
Yes, we have just received 2 further written questions.
Yeah. And sorry, I think on that subject, I think given that we do have a bit of time, I think maybe we should give people time, because I see that these calls and questions are sort of, I don't know, maybe the delay in transmission, but coming through slowly. But anyway, let's deal with the 2.
Yes, Paddy, let's take the question.
Perfect. So the next question is from Anoop Fernandez from Psycho, who asks, given the scale of renewables capacity with the company is going to add, and with the addition of hydrogen, do you expect renewable and or carbon credits to account for a sizable part of your earnings in the future?
The short answer to that question is, I am sorry, I'm not going to be able to tell you with any level of certainty what the carbon credit future is going to be like. Okay, to start with, everybody talks about carbon credits. There is a huge desire, increasing conviction that there should be a buoyant market emerging, but it's not there yet, and everybody's working at it. PIF in the kingdom is creating a platform, etc., but we're not quite there yet. So that's the first answer. So I mean, if I start giving numbers, it will be meaningless. And we don't, by the way, for the moment, we're not forecasting and we're not including those kind of things in our financials. But what I can tell you is that yes, we will be generating carbon credits. In some of the contracts, the procurement processes are structured in such a way we share those carbon credits. In fact, there is one contract in which even the carbon credits doesn't belong to us; it belongs to the off-taker. So we sort of, we respond to client demands, clients' requirements, and we respond to tenders, and so we've got to comply with those requirements. So where that is the framework, we have to comply to. So, but having said that, we do have carbon credits. We have traded carbon credits. At this stage, the revenue generation through carbon credits that we're generating is very, very modest. In the grand scheme of things, they don't add significantly to our financials. But with the volumes that we are developing, you're quite right. As we go forward, we should look forward to some positives, but I wouldn't want to start speculating on any of that. Next question. Sorry, thank you. Next question.
Thank you. Our next question is from Tom Scootney from Global Water Intelligence, who asks, do you see other assets in your portfolio that are suitable for refurbishment or replacement before the end of their existing service agreements in the mould of the Shoaiba 3 plant? Thank you.
Okay. As far as, first of all, I think it's a publicly stated intent of the kingdom in order to decommission its entire fleet of oil-fired power generation and desal water production assets by 2030. So there is a program that is underway. Systematically, assets that we own, assets that other people own, that fit within that oil-fired framework are all being reviewed and repositioned. So we will have a few. We've got 2 more, and we can expect those 2 within the next few years to be repurposed, repurposed. So that's a straightforward. Now, in terms of the other operating assets that we have within our portfolio, look, generally our portfolio is fairly new, and they're all serving a contract of long duration. Again, I think IPO documents have got it, but I think our average sort of residual life of our contracts are something, in double-digit 20-something plus 20-something years. So we're not expecting to see major retrofits and refurbishment. We will continue to, for example, increasing supply security. We will continue to enhance, add, improve, but these are not any significant sort of retrofits of our existing fleet. By the way, let me just recorrect. In terms of oil-fired, I think the residual fleet in our entire portfolio of 64, but the number keeps increasing. Assets, we've only got 4 oil-fired assets, so I can fully expect all.
One was sold, I think.
We started out with 4, so please. So we've already sold 1. We are busy refurbishing or we are reconstructing one, the Shoaiba. So I was right. So we've got 2 left. Yeah. Hopefully, I've answered that question.
Thank you. As a reminder, please press the raised hands icon on Zoom or type your question into the Q&A chat box, or please press star 1 if you've joined on the telephone line.
Yeah. So.
Lauren, I guess this time we don't have any questions.
Yeah, we have no further questions registered, so I'll now hand back over to you, Oscar.
Okay, thank you very much. And in any case, whoever's in the call, you can reach out to us if you end up with any further questions. Thank you for listening to us, and thanks Paddy and Abdul Hamid for taking us through the material. I think this is that's the close of our session. Thank you very much, and good evening, good afternoon, good morning to anyone.
Thank you.
Thank you very much. Thank you for your time.